Welcome to Han Invest TV. Today we explore the harsh economic reality of 2026, where average incomes simply cannot survive. Meet Marcus. He is 31 years old and earns $78,000 a year, which sounds like a great salary. Despite living a very frugal lifestyle, Marcus constantly struggles to pay his basic bills and keep his financial head above the water. Let us break down his monthly expenses to understand why earning a decent wage no longer guarantees a comfortable or stable life. First, taxes take a massive bite out of his paycheck, leaving him with much less actual cash than his gross income suggests. Next is housing. Rent prices have skyrocketed across the country, consuming nearly half of his remaining take-home pay every single month. Then comes the car payment. Reliable transportation is essential for work, but auto loans now demand a huge portion of his budget. We must also consider insurance costs. Health and auto coverage premiums have surged, draining his wallet before he even buys any food. Speaking of food, grocery prices remain incredibly high. Basic necessities like bread, milk, and eggs cost significantly more than they previously did. Marcus also pays for modern necessities like internet and phone plans, which add another heavy layer to his mounting monthly financial obligations. He keeps a few small subscriptions like Netflix and Spotify for basic entertainment, but these are minor compared to his major expenses. After paying all these essential living costs, Marcus looks at his bank account and realizes he has almost nothing left to save. This is the modern trap. He works hard 40 hours a week, yet building an emergency fund feels like an impossible dream. Investing for the future or saving for a down payment on a house seems completely out of reach for this young professional. You might think this is just a problem for single people, but the reality is even worse for families trying to survive. Let us shift our focus to a typical family of four. They earn $133,000 every single year. This impressive household income puts them in the top 25% of earners, which should theoretically provide a very comfortable lifestyle. However, when we examine their monthly budget, a terrifying financial picture emerges that shatters the illusion of the American middle-class dream. The biggest crushing expense for this family is childcare. Daycare costs for 2 young children often exceed the price of their mortgage. Their housing costs are also astronomical. Property taxes, home insurance, and high interest rates make home ownership an incredibly heavy burden to bear. Feeding a family of 4 in 2026 requires a massive grocery budget, leaving almost no room for dining out anymore. Healthcare premiums for a family plan eat away at their income, and unexpected medical bills can easily push them into severe debt. They also need 2 reliable vehicles to commute to work and transport their children, meaning double the car payments and insurance costs. Utilities have increased dramatically. Heating, cooling, and electricity bills take a much larger percentage of their monthly income than in previous decades. Even with careful budgeting, this high-earning family discovers that their essential expenses completely consume their impressive $130,000 salary. In fact, after calculating every necessary cost, they are actually losing money each month and slowly sinking deeper into credit card debt. How did we get here? How can families earning 6 figures be living paycheck to paycheck without any financial security or savings? To understand this modern economic crisis, we must look back at historical data and compare our current situation to the 1970s. 50 years ago, a single average income could comfortably support a family, buy a house, and still leave room for significant savings. Back then, housing prices were closely tied to local wages, making the dream of home ownership accessible to almost every hard-working citizen. Healthcare costs were reasonable and manageable out of pocket, unlike today, where medical debt is a leading cause of personal bankruptcy filings. A college education could be paid for with a summer job, allowing young adults to start their careers without crushing student loans. Today, the reality is completely inverted. The cost of housing, healthcare, and education has exploded, while wages have remained painfully, stubbornly stagnant. Worker productivity has increased massively over the past few decades, but the financial rewards have not been passed down to average employees. This massive disconnect between stagnant wages and skyrocketing living costs is the true root cause of our current middle-class financial crisis. Many financial gurus will tell you to stop buying daily coffee or cancel your streaming services to fix your broken monthly budget. But this advice is fundamentally flawed. Skipping a $5 coffee will never solve the problem of a $3,000 mortgage. We need to stop blaming small personal indulgences and start looking at the massive structural costs that are truly destroying our wealth. The real financial drains are housing, transportation, and childcare. These are the major categories where families are losing their hard-earned money. If you want to survive this economic environment, you must focus your energy on optimizing these three massive areas of your budget. First, reconsider your housing situation. Can you downsize, relocate to a cheaper area, or find creative ways to reduce your monthly rent? Second, rethink your transportation. Buying a reliable used car instead of a brand new one can save you thousands of dollars annually. Third, childcare is incredibly tough to hack, but exploring family support networks or alternative working schedules might provide some much-needed relief. Once you manage to reduce these major expenses, you must urgently prioritize building a robust emergency fund to protect your financial future. An emergency fund is your only shield against unexpected job loss, sudden medical emergencies, or major home repairs that could ruin you. Aim to save at least 3 to 6 months of basic living expenses in a highly accessible, high-yield savings bank account. Having this cash buffer will give you immense peace of mind and prevent you from relying on high-interest credit cards later. After securing your emergency fund, the next crucial step is to start investing your money as early and consistently as humanly possible. Saving money is no longer enough because inflation will slowly destroy your purchasing power over time if your cash just sits idle. You must put your money to work by investing in assets that grow faster than the rising cost of everyday living expenses. Broad market index funds are fantastic starting points for beginners, offering diversified exposure to the stock market with very low fees. Even if you can only invest a small amount each month, the power of compound interest will grow your wealth significantly over time. Consistency is the key to successful investing. Make it an automatic habit and do not let short-term market fluctuations scare you. The economic landscape of 2026 is undeniably harsh, but understanding the rules of the game is the first step forward. Marcus is learning these hard lessons right now. He recently decided to sell his expensive car and buy a cheaper used vehicle. This single decision freed up several $100s in his monthly budget, which he immediately redirected into his new emergency savings fund. He also negotiated a remote work arrangement, allowing him to move slightly further away from the expensive city center to save rent. These strategic moves did not require him to sacrifice his daily coffee, but they fundamentally improved his long-term financial stability significantly. The family of 4 is also making bold changes. They realized that maintaining their current lifestyle was leading them straight towards bankruptcy. They made the difficult choice to downsize their home, trading a large mortgage for a more manageable monthly payment in the suburbs. This massive reduction in housing costs finally gave them the breathing room they desperately needed to stop accumulating more credit card debt. They also started meal planning meticulously, cutting their massive grocery bill down while still eating healthy and nutritious meals together at home. Financial survival today requires a proactive mindset. You cannot simply follow the traditional path and expect everything to work out perfectly fine. The old advice of just working hard and saving 10% of your income is mathematically broken in our current economic reality. You must become the active manager of your own financial destiny, constantly seeking ways to increase income and aggressively reduce major expenses. Consider developing high-income skills or starting a side hustle to bring extra cash into your household budget every calendar month. The gig economy, freelance work, and digital businesses offer unprecedented opportunities to generate additional revenue streams outside of your primary daily job. Every extra dollar you earn can be deployed directly into investments, accelerating your journey towards true financial independence and lasting wealth creation. It is also